Welcome back to New Zealand Property Insights. I'm Paul Roberts.
And I'm Debbie Roberts. We're the owners of Property Apprentice. And as always, we're here to help you to navigate the New Zealand property market with facts, not just headlines.
Today, we're looking back to look forward. We're diving into the great interest deductibility experiment, a 3-year policy shift that has had a massive consequences for the rental market before being quietly reversed.
It's a vital lesson in how policy affects people, not just numbers. But it's not all history today. We're also looking at the current first home buyer renaissance. First home buyers are now accounting for over 27% of all sales and are currently getting significantly more house for their money.
And for our third segment, we're talking about the new AML reforms. Finally, some common sense is coming into the property transaction process, especially for those of you that are using family trusts.
It's an episode about learning from the past and capitalizing on the present. So let's dive in. So starting off with the interest deductibility experiment, a costly lesson. Starting with a look at that policy that reshaped the rental landscape in New Zealand. Back in 2021, the previous government removed interest deductibility for residential investors. And as we look at the results in 2026, the data shows that the experts were right to be worried.
Exactly. The Inland Revenue Department had warned the policy wouldn't improve affordability, but would instead push rents higher. And sure enough, those warnings were played out across the country. The facts are the policy removed the ability for residential investors to deduct mortgage interest as a tax expense, which is a company benefit. That's why you run companies, effectively taxing all mum and dad investors on profits that they hadn't made. It's essentially worked as if the rental properties were mortgage free, which for a lot of people, they're not. When mortgage rates climbed from 2% to over 6%, the policy became catastrophic for investors with mortgages, as their largest expense in the rental property was no longer recognized in the tax system.
Consequently, national average rents hit record highs of $600 a week, with Wellington reaching $695 and Auckland CBD at $620 a week. Overall, it was approximately a 20% increase in market rent in less than 3 years. Inland Revenue's initial assessment proved correct. The move reduced long-term rental supply and failed to meaningfully improve housing affordability for buyers. In fact, arguably, it actually made it harder for first home buyers who were renting to save for their house deposit because rents were increasing. As new builds were excluded from this stupid rule change, it also pushed investors into the new build market, putting them in direct competition with first home buyers who could buy new builds with a lower deposit due to the deposit exemptions from the RBNZ, those pesky LVR rules.
Following the election in 2023, the current government acknowledged that punishing investors had squeezed tenants, and they restored full interest deductibility as of April 1, 2025. The lesson from this experiment is that making rental properties structurally unviable for private investors primarily harms tenants through increased costs and reduces choice. So what does this sort of mean? Well, this segment really highlights the unintended consequences of using property as a political football. When you treat investors like a problem rather than the provider of essential housing, the person who actually pays the bill is the tenant.
It's so true. Seeing average rents hit $600 a week was a direct result of landlords being forced to pass on those massive tax costs whenever possible, just to help with paying the tax bills, combined with supply versus demand. When there's limited supply of rental properties and high demand from tenants, market rents increase. It wasn't about greed. It was about survival for many mum and dad owners who were being taxed on money that they'd never actually made.
And for those looking at the Australian market right now, where this debate is happening, our experience is a clear warning. You can't you can't tax your way to a healthy housing market. You have to build your way there.
Exactly. And now that the policy has been reversed, we're seeing more stability returning to the rental pool. It's a reminder that strategy, not just responding to the latest tax tweak, is what builds long-term wealth. Also, it should be a solid reminder to both sides of the government that supply and demand is what causes house prices and rents to go up or down. Literally, the reason house prices have been so stable over the past few years is due to the number of new builds that hit the market. And look at how many first home buyers have been able to purchase their home because of that.
Yeah, in some areas, we've seen reductions in market rent due to the number of rental properties available. Supply and demand is doing its job. Basic economics, really. So let's have a look at our next segment. So the first home buyer takeover. While the property market has been nice and stable with little or no capital growth, putting some investors off who might have forgotten that property investing is a long-term strategy, not a short-term quick fix, first-home buyers have absolutely been charging ahead. Fresh data shows that they have been taking advantage of a hollowed-out market to secure exactly what they want.
It's an incredible shift. First home buyers bought nearly 25,000 homes across the country in the 12 months leading up to the end of Q1 2026. That's the highest volume we've seen since the peak of the 2021 boom. So let's have a look at some of the facts. First home buyers currently make up 27.5% of all property purchases, with some regions, like Wellington, for example, seeing first home buyers accounting for 37% of activity. Mortgage costs have dropped significantly. In most regions, excluding Auckland, minimum payments are $820 a month lower than they were in 2024.
In Auckland, the drop has been more dramatic, with payments roughly at $1,100 per month lower than 2 years ago. The median price paid for first-home buyers is currently $720,000, which is only $20,000 shy of the peak of 2022, suggesting buyers are choosing higher quality homes rather than just cheaper ones.
Over half of all first-home buyer loans are being done with less than a 20% deposit, and the average LVR, loan-to-value ratio, has risen to 81%.
The average age of the first home buyer has dipped slightly to 35, down from 36 in 2024. So that's $1,100 a month in saving in Auckland. That is life-changing for a young family. And no wonder they are flooding back into the market. They aren't just buying starter flats anymore. They're buying that middle 40% of the market.
And that's the bang for buck that we've been talking about. Because they have the pick of the bunch, they're becoming more active across the entire value spectrum, not just at the bottom.
And notice the LVR figure, 81%. Banks are clearly more comfortable lending to this group, even with smaller deposits. It's a sign of a healthy, functioning market when the people who want to live in homes are the ones winning at auctions.
My big tip for home buyers, as well as investors, look at the opportunities that this market stability provides. You've got the leverage to negotiate terms that suit you. This is a buyer's market for home buyers and investors. You don't even have to compete with each other. We can happily coexist in the current market. There's plenty of opportunities to go around, but it does mean that you can lock in your purchase price and interest rates before they get any higher. So get amongst it.
And we definitely don't want to go back to having restrictions and more taxes where it's just going to make it more costly for every single New Zealander, regardless if it's you're just saving for a deposit.
Exactly. Or whether you're still a tenant.
Yeah.
Okay, so let's have a look at the next segment, AML reforms, cutting the red tape. We've finally got some good news for anyone who's ever felt like they were being interrogated just to buy a house. New anti-money laundering, or AML reforms, are coming into effect, and they are designed to be smarter and more proportionate.
The RAINZ has been pushing for this for a long time. The goal is to keep strong protections we need against financial crime, but stop the unnecessary friction for standard residential deals, especially for things like family trusts. So the government is shifting towards a risk-based framework that reduces red tape for low-risk transactions. A major win is the relaxation of enhanced due diligence. Requirements for simple family trust, which are commonly used by everyday Kiwis for property ownership.
Associate Minister of Justice Nicole McKee confirmed the changes are aimed at being more proportionate and focused on genuine risks rather than just ticking boxes for regular buyers. The property sector is now categorised as lower risk, meaning real estate businesses will shoulder a smaller portion of the AML, anti-money laundering levy, compared to the banking sector, which will pay roughly 85% of the total.
REINZ General Counsel, Melissa Bright, noted that these changes strike a balance between maintaining safeguards and reducing the compliance costs that often lead to transaction delays. So anyone who has a family trust knows the drama of AML compliance. It can feel like you're being treated like a drug cartel just for moving your family home into a trust. This risk-based shift is a massive win for just simple common sense.
It really is. And Melissa Bright was right. This is about striking a balance. We need the protections for anti-money laundering, but we don't need to spend big money and a truckload of hours on low-risk family transactions. It should speed up the entire buying process for people in that situation.
And the fact that banks are now taking 85% of the levy cost reflects where the actual volume of transactions sit. It means real estate agencies can keep their overheads down, which is good for everyone.
The red tape is finally being trimmed.
So that wraps up episode 15. We've looked at the hard lessons of messing with tax policy, and a lesson that our neighbours in Australia and the UK are learning the very hard way, and actually taking some notes of what we went through in New Zealand, the exciting rise of the first home buyers, and the long-awaited trimming of the AML red tape.
Yeah, it's a shame that Australia and the UK didn't learn from our mistakes, because we've already been down that road and seen what happened. So they're going to learn that the hard way. But it is a market of nuance right now in New Zealand. While the headlines might say things are slow, the reality for buyers and compliant investors is full of opportunity. And this window of opportunity won't be around forever.
So if you want to learn how to navigate the current property market, join us for the next free event online, How to Succeed with Property Investing.
It's 100% free, educational, and we'll talk about all of the different property strategies our clients are using right now. You can find the link in our show notes or visit propertyapprentice.co.nz to register.
Thanks for joining us. Stay informed, stay strategic, and we'll see you the next time.
Happy investing. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.